A lot has been said about DHFL, that Freaky Friday from last year. We keep hearing about how there will be a monetization, divestment of DHFL. But till then, would you press the panic button as we've seen on the street? I'm not talking about the stock price. I'm talking more about unit holders. I'm talking more about mutual funds.
Yes, Mehta, I think I believe the largest defaults in the history of mutual fund industry, at least from the perspective of the spread it has. Almost 136 debt funds carry the paper, which is a very large exposure in terms of quantum, which you've specified, 6,700 odd crores. In terms of the spread, you name it, and most of the AMCs actually have exposure to this paper. So it is the largest catastrophe from a debt default standpoint. Of course, the light at the end of the tunnel from a perspective of where money can come from, fund managers whom we interacted with are reasonably confident that it's just a liquidity mismatch. Of course, there has been a large crisis at the DHFL end, but this payment can actually be met by three different sources. So basically, point one I'm making is it is a widespread problem. Point two I'm making is it's very important for the investor to be more pragmatic, more patient, evaluate the cost and benefit of an exit from a fund which he or she is already invested, and then take a prudent decision rather than being in haste and getting out of a fund where the impact of cost and tax could be greater than the actual write-off of the entire paper itself.
Feroze, you know very well how ET now is committed to financial inclusion, how we're running that Jan Nivesh program, we're talking about financial inclusion, we're getting viewers to pledge one day's wealth into mutual funds. So once again, I'm going to ask you this, what are you telling your clients in light of this big default that is coming in, the highest ever in the mutual fund industry's history over here? What's your advice to them? I know you said don't press the panic button, don't jump to a conclusion, but that's very easy to say when it's not your money, right?
No. See, if the panic button has to be pressed irrespective of whose money it is, it needs to be, the decision has to result in some risk mitigation. If 75% of my papers have been written off as of yesterday or today's NAV, then automatically, removing the fund is not going to serve the purpose, because the fund is assuming the money is not coming back. So the damage is already done. Unless you redeemed it on the 3rd of June, then definitely it would have been a prudent decision. So point one I'm making is hard-earned monies of different individual investors have been invested. So it's very important for the industry to safeguard their interest, no taking away from it. Point two, which I'm trying to re-emphasize, is that if a person has not exited on 3rd of June, it does not make sense as of now to exit, because 75% of the paper is going to be marked down in today's NAV. Point three is that when you exit, there's a cost and a short-term capital gain tax impact, which can supersede the actual 25% of the value of the paper, which is still incorporated in NAV. So very importantly, out of the 136 funds, there are about 50 odd funds which have 8% and more exposure. Those are the funds which require more vigilance. Anywhere there is a lesser than 8% exposure, I would say most of the damage is done. There's no management which will help you, and you just go with the tide and sail through it, because we've already written off most of the NAV from coming from DHFL. So 8% and below, you don't have to actually do any action. 8% and above, you need to actually sit down with your advisor, check the impact, and then take a decision. Is the sole point I was making.
Feroze, the other point I wanted to raise before I let you go, it has been a trying time for the mutual fund industry. It started in September. It all started with INFS. You've had the Reliance issue then of late. Then you've got the FMP issue which has come. Now it is DHFL. So, when your clients are coming to you with the kind of events which have taken place in the last 6 months, do you still see them? Do you still advise them to invest in debt mutual funds, or are you perhaps rejigging the portfolio more towards, let's say, equity mutual funds?
We are still recommending debt mutual funds because the entire category, which is almost about a 14-15 lakh crore category, cannot be written off on one such accident because at least from our desk, we've been recommending credit risk funds which are more diversified. There are at least 40-50 bonds in it. Those funds, even after these defaults, last calendar year, have generated close to 6.5-7% return. So if the write-off was so large that the return would have completely got eroded, then I would have probably, like you rightly said, told investors to just take the equity risk because if debt is going to yield you no return. So even after this kind of a write-off, most debt funds have generated between 6 and 8% return last year, at least on the credit risk fund side. And when it comes to DHFL, there are three things which you have to consider and then take a pragmatic decision. Point one, the DHFL has a 2,200 crores of approximate EMIs coming to them. That hits their account on 10th of a specific month. That's one good news, that the 950 crores which has been defaulted has some ray of hope. Point two, there are two subsidiaries which they're wanting to sell, Avance and Aadhar Finance. That can result in some cash flow. And point three is, I think there is a lot of asset sale which is being spoken about. I think these are the three sources which can actually result in money coming in and this grace period being utilized effectively to come out of this default situation, which it is technically not yet. So hope for the best, and I'm sure what are the key learnings which an investor should take is point one, when you're buying a debt fund portfolio, make sure you have a most diversified portfolio. Don't keep all eggs in one basket. Combine 10 debt funds and the risk will automatically come down because you've spread your risk thin enough. Even if a few companies go default, you will still end up making 6 to 8%.